Fools, we are so delighted to have the opportunity to speak to Jay Hatfield, the CEO and founder of Infrastructure Capital Advisors. He heads up the firm's research, strategy, and trading and manages several of the firm's funds, including the Virtus InfraCap U.S. Preferred Stock ETF, the ticker is PFFA, which is a recent recommendation of our Ultimate Income service here at The Motley Fool. Jay has 3 decades of experience in the securities and investment industries, including as a portfolio manager at SAC Capital. He also has extensive research and experience in investment banking and played a key role in the formation of NGL Energy Partners, a publicly traded master limited partnership. Jay, thanks for giving The Motley Fool some of your time today.
Great. Thanks, Matt. It's great to be on.
All right. Well, before we get to know more about you and Infrastructure Capital Advisors, I was wondering if you could talk a little bit about preferred equities in general, because it's not an asset class that I think the vast majority of our Motley Fool members or readers have experience with. What are, in your mind, some of the big advantages of investing in preferred stocks, and why is it an area of the market that investors should probably pay more attention to?
Well, there's really 2 critical advantages of preferred stocks. The first is that they're high quality companies that are public, that issue securities that are senior to common, so they get paid first. So they have way less risk than the common of the same company. But yet they have very good yields, which usually results in very good total return. So a lot of the yields are 7, 8, 9, like our fund yields around 9 right now. And so you get returns, potential returns, that are competitive with the market, probably below the market. Market usually does 10, 11. If you're all in tech stocks, you might do 15 or 20. But with way less risk, they're about 40% as volatile as the market. The default rate has been extremely low, about 0.6% a year. So you really retain most of that 8%. So it's a good way to have kind of a base load, even if you have some speculative stocks where you get paid every month, and then you can recycle that money either into other stocks or buy more. So really a great asset class of public companies. And then we only invest in preferreds that are listed, so they're easier for us to trade. There's less friction, and we usually do it in a way where we don't have to pay substantial commissions. So a really efficient asset class that I would recommend. You can do it yourself, so a lot of work. It's hard to build a diversified portfolio. It should be diversified with fixed income, not necessarily with stocks, but with fixed income. Since they have limited upside, there's no real advantage to concentration.
So Jay, kind of on that point, like investors have many choices to generate income today. You can look at dividend-paying stocks, investment-grade bonds, high-yield bonds, real estate, plenty of other income-producing securities out there. So what are some of the benefits of preferred equity compared to some of those other income-producing alternatives?
Well, the way to think about it is they're very similar to high-yield bonds. They have lower default rates but similar yields, so probably in the long run they'll have better returns. And they do well. So both high-yield bonds and we have a high-yield bond fund, BNDS, do well when the stock market's stable to rising and rates are stable to dropping. And so we're in an ideal market for higher risk bonds. For investment grade bonds, so there's a competing fund, BND, that's run by Vanguard, that is investment grade, but they're only yielding 4, and they only benefit when yields drop, and we think yields are going to drop a little but not a lot. So you can get better total returns when we're coming out of a tightening cycle, because the Fed causes all recessions. Fed's loosening now. And so when the Fed's loosening, you want to have higher risk fixed income, not lower risk fixed income.
Well, let's talk about then the Virtus InfraCap U.S. Preferred Stock ETF. PFFA is the ticker. As I mentioned, we recently recommended the fund in one of our portfolio services here at the Fool. What is the primary strategy of the PFFA fund? And I'd love to know how it differs from other preferred equity ETFs that exist in the market. One example, of course, being PFF, which is the iShare Preferred and Income Securities ETF. It has a very similar ticker, to PFFA. But I will point out that your fund, PFFA, has handily outperformed that fund. In fact, more than doubled its return since inception in 2018. How have you been able to do that, and what are the key differences?
Well, I'm sure your listeners and viewers have, heard from companies like Vanguard that it can be better to be passive when you're buying indexes or mutual funds or ETFs. But that only holds true for equities and not fixed income. And the reason for that is with equities, they're cap weighted, and that can be great. Because when you're cap weighted, you tend to get the best stocks and you get momentum, which is wonderful.
Right.
But with fixed income, you're doing the opposite of what you should do, because these securities are callable at par. So if they're up, then you want to actually sell them, not buy them. And all these large index funds, 70% of the market, PFF is the biggest, are in fact index funds. So they buy high and sell low. And like I said, that actually can work in the stock market because you get more NVIDIA and get more of the high-flying stocks. But it's a terrible idea. So we're actively managing call risk, was really what I was talking about. So they're doing the opposite. But when security goes above par, we start selling it, usually to the index funds because they don't have any smart beta rules. And when they get inflows, their market makers just go and buy the securities and we can sell it to them. Or if they're rebalancing, which they do every month. We also manage interest rate risk, so we had less interest rate risk when the Fed was tightening because we correctly forecasted that inflation was going to not just rise but skyrocket. And so we anticipated that. And of course, we're constantly managing credit risk. You don't want to be in weak preferred stock credits because they don't do well if there is a bankruptcy, so you want to sell them. And then finally, we can do new issue, so participate in new issues. The index funds cannot. They get listed, and typically all the index funds then bid up those securities, and we start selling to them because they're good companies and they're liquid. So we start selling to them at higher prices, so we're able to get significant gains without taking significant risk, whereas the index funds cannot do that.
Wow, so that's interesting. I can imagine a lot of investors, retail investors in particular, don't know that. But it's what you're saying is it's actually in the bond and fixed income world and in the preferred equity world. It sounds like active management is what you want to be following. Whereas
it's really critical. I mean, you can, like I said, you can go look. There's listings and Barron's and other sources, maybe on Motley Fool, for preferred stocks, but you also have to do a lot of analytics because you can say, oh my gosh, this is great. There's a Ford preferred trading at a 9 yield, but you don't realize it's trading at 26, callable at 25, and it's going to get called anytime, or it might have already been called. So you do have to do a lot of work. You don't want to be in low quality credits. You've got to manage the interest rate risk. So you can do it yourself, but it's simpler. Like I don't do it in either my personal account. I levered PFFA in my personal account. IRA 60%, 65% PFFA.
Wow.
And the reason for that is that I don't want 200 preferred stocks in my IRA. It's just it would be an unbelievable mess, and it's not worth it for me to go in and manage each security and say, oh, well, I have 1,000 shares of this preferred and it's trading at $25.50, and I'll sell it. Like, I don't have time to do that. I have to, of course, manage PFFA, but even for anybody, that's just like, it's not really worth your time. Like, it's, if you have a diversified portfolio of preferreds, why bother? But for us, we have hundreds of thousands of shares, and we have institutional trading techniques to, take advantage of that. So there's economies of scale for having an ETF managed, by people like us, where it's absolutely worth their time to worry about whether you sell it at 25.50 or 25 and a quarter or 25.75. So a unique situation where, like I said, perfectly reasonable to go buy your own stocks, do your own work, but it's way simpler, or buy an ETF that's just an index fund, but harder to do it yourself on preferreds and bonds. Bonds aren't usually listed, and can create a big distraction in your portfolio when you should be worrying about selling Tesla at 475. You're staring at all these preferreds moving around by 5 cents every day.
Right. Well, I think anyone interested in PFFA or already investing in PFFA is going to love hearing that you have 60% of your IRA in the fund. That is quite a high exposure.
Yeah, I actually have 300% of my personal account, which I definitely do not recommend, but I have it levered. So
you're levered. Wow.
Yeah, don't do that. But I have other funds. I could, if there's a margin call, I could send it in there. But so I don't recommend that. But you actually, again, don't do this. But you can get really get equity-like returns, not just like 8 or 9, but you can get 20 if it doesn't, if there's no big dislocation in the market. But that's an if. So don't do it.
Okay.
It's like David Letterman. Do not try this at home.
Right. Well, one of the things that's really appealing about PFFA is that for the past 5 years, 94% roughly of your fund's distributions have been covered by the fund's actual income. So the actual dividends you're getting on the preferreds, any interest, any net gains you guys are making. You look at so many actively managed ETFs or closed-end funds, and a much larger percentage of the distribution comes from return of capital. And of course, over time, that can degrade the net asset value of the fund, and we see that happen so often. How have you been able to have such a high percentage of the fund's distributions covered by actual earnings? Is that a nature of the asset class of preferred stocks, or is that just your management style?
Well, I would urge investors to look at SEC yield to evaluate that. I mean, you can see, as you indicated, that our SEC yield is in fact in line with our distribution yield. It does vary slightly from month to month, but it's a good gauge, and you should really do that on all ETFs that pay substantial yields. Sometimes the financials are difficult to analyze because of tax differences, and we're growing pretty fast. But so if you're nervous about the coverage, definitely look at SEC yield. But to your point, we do cover the dividend. We don't follow the other thing. When I mentioned we manage credit risk, we don't follow the rating agencies. They have a lot of biases that we don't agree with. They don't like what is called, they call pass-through entities, we would call dividend stocks. So they don't like REITs, they don't like utilities, they don't like pipelines, because what they do is, it can be a super risky company. I don't know, MicroStrategy is a good example, but some tech stock. And they say, okay, well, what's your leverage in 5 years? And, of course, it's zero. They don't pay any dividends, so it's zero or some really low amount. But for utilities or all the companies I mentioned, if you forecast it, well, it's the same because they're paying out, their sustainable cash flow, or at least a good portion of it. So, but we don't agree with that. We have the opposite view. We're like, well, they can cut the common dividend, and then the preferred's really well covered, and then they de-lever, and they have phenomenal collateral. Like, we want collateral. We don't want, Bitcoin can be an okay collateral as long as it stays at a reasonable price, but utility assets are phenomenal. Regulated utilities, collateral, most pipelines, great collateral, most modestly levered real estate, phenomenal collateral. So the rating agencies don't seem to care about collateral. We do, and that's served us well. So we've had no material defaults, but yet get better yields because the rating agencies, because they rank them lower. Like a good example is Energy Transfer. If any of your clients ever invest in pipelines, one of the biggest pipelines in the United States, BBB plus credit rating, so de minimis credit risk for the bonds. But the rating agencies also don't like preferreds. That's the other thing I should have mentioned. They penalize it by 3 notches. So it's a BB rated security, and it yields about almost 7.5. That's one of our biggest holdings. So you get these mispriced securities where really You have investment grade, which, the average default rate on investment grade is like 0.1, so de minimis default risk, but really attractive yields. And if you manage that appropriately and you do what I already mentioned, which is you take advantage of these anomalies where you're selling above par, buying below par, doing new issue, selling above par. And then also sometimes preferreds get hit. Sometimes that's rational because there's more default risk. Sometimes irrational, so we'll go analyze it, take advantage of opportunities. So it's actually entirely reasonable to beat the dividend because you're doing all this optimization activity and get a better return. And we suspect that, when preferreds go back to normal, like a lot of them are trading below par, when we're in between Fed cycles, recession cycles, usually preferreds go back to par. So when most of them go back to par, our portfolio will rise. And then when you look back, you'd say, oh, actually, now the yield's 8, but the total return over since inception is 9 or 9.5, 10. And that's because we're bad golfers. Like all day long when we're not talking to folks like you, we're analyzing companies. That's what I was doing. I was going over some credit analysis, or we're doing small trades to optimize the portfolio. So if we're doing that all year and we don't beat the coupon, that would be a disappointment to us. So that's why you can get attractive total returns, is that there's this inefficient asset class because of the rating agencies, because of all these index funds, that we're optimizing for you. So if we do that diligently, which we do, we should be able to beat the coupon.
And I love how you also highlight, the fact that if you're investing in any security that also has a common, that's even more buffer. I mean, it's not collateral, but it's even more of a protection against the preferred, of course, which has to be paid first before any common dividends can be paid. With all that you said, I mean, if you're looking at PFFA or you're already an investor, is there any worry at all about the current 9% yield being able to be covered?
We don't think so. And one thing also to point out, but by focusing on these public companies, because keep in mind, high yield bonds are often issued by private companies that are run by private equity firms. So sometimes they'll issue a ton of new equity. Like there's a lower quality REIT, HPP, and they issue like $350 million in common equity, diluted the common holders, but protected the preferreds. But we actually are in a great situation. So let's say that it was, well, it's not a good example. The pandemic's not a good example, but if we're headed into a Fed tightening cycle, there's two bad things about that. First of all, our cost of borrowing rises, so we do borrow 20%, which is very low, way lower than all closed-end funds, but it would be a drag on our distribution. And then normally when the Fed tightens, we didn't have this, except a couple of banks blew up, but we didn't have a recession and substantial defaults. So now we're coming out of a tightening cycle. It's actually the opposite. Our borrowing costs are going lower, so we're making a higher spread on the leverage. And the probability of default is dropping, and you can see that in the movement in the stock market. Stock market movements are a proxy for the probability of a default. So the more likely case is we'd make a very small increase, no guarantees. We look at that every year. But that's really the fruits of our labor. If we're doing all that optimization activity, and doing obvious trades, selling above par, buying below par, it adds just a little bit more income. And we're highly motivated to pass that through, partly because we're big holders. And, we'd like to have more income in our IRAs and retirement accounts. But we can do that because of this daily, and we do it every single trading day of the year. We don't take vacations. I might be on vacation, but I don't take a vacation watching the portfolio. And so if we do that every day logically, which we are at a minimum logical, we should be able to slightly increase the dividend, which is pretty unusual for fixed income. It's normally not the case.
Yeah.
And so, Jay, you mentioned the leverage you use, the leverage that PFFA uses. I think it's typically around 20 to 30% of asset value.
I mean, 15 to 25 is a good way to think about it.
Awesome. So, like, could you just elaborate on how you determine when to increase leverage and when to maybe adjust leverage lower? Like how do you think about that?
Yeah, certainly. So we're targeting 20. Sometimes it goes higher because we take on new issue and then we slowly sell securities down. But we're targeting 20. And when market conditions do get sloppy, to use a technical term, non-technical term, I guess, which is not hard to assess. So like during the tariff tantrum, we took leverage down, took it down to about 17. We didn't really think the tariff situation was that significant because tariffs are only 10% of the economy, not 100. During the pandemic, we took it to 0. So we will take the leverage off. It's another, we don't usually mention it, but thing that we can manage other than interest rate credit risk. We also manage the leverage risk. And so that's a good way to add value. It's not that difficult. I mean, we don't use, AI or something. We just look at the market or market whispers. If it's, down horribly every day and there's some catalyst, and we'll modestly take down the leverage if we don't think it's that substantial. During the pandemic, that obviously was material. It was really dumb, arguably, to shut down the economy, terrible for the economy. So we'll take that to 0. So we do actively manage it. But we're starting from a really low level. A lot of closed-end funds around 45. We have hyper liquid securities, so we can quickly get to 15 and then work down to 10. So at those levels, it doesn't really impact volatility and returns substantially.
Awesome. Thanks for that. With preferred stocks, there's several different types of preferred stocks that you can own. You have fixed rate preferreds, floating rates, fixed to floating rate, convertible preferreds, presumably a lot more than that. How do you determine which preferred stock to put in the portfolio? Like, do you have any preferences, or does it just kind of depend on the value and the risk-adjusted return potential that you're seeing at any given time?
Well, it's a great question. I didn't want to pontificate too much when I was talking about interest rate risk, but that's the primary tool we use to manage interest rate risk. So we loaded up on floating rate preferreds during 21, particularly in late 21. We also sold low coupons. Low coupons have more interest rate risk than higher coupon securities. So we did those two things to manage interest rate risk. So we were able to maintain a dividend because we had 30-40% floating rate. And then now we're down to 12. And it's important to note that that could go to 0 pretty quickly, because a lot of times when the fixed to floating feature is meant as an offset to the call feature. So when there's an institutional preferred, and ones we participate are typically institution, sort of obviously, so we'll demand to get it floating. It doesn't really matter now because it's floating in 5 years. So it's fine to get floating now in 5 years. I'm talking currently floating. But when it actually goes floating and the rates are higher, which they are, then the company calls it. So it's meant to make it a fair bet, like not heads, the company wins, like if rates are lower and they call it. But tails, they're higher, and then they're forced to call it because the rate is just so attractive. So like there's some SCE preferreds, they're actually bonds, but they're structured like they are preferreds. They're going to go floating, and we think they're going to call them. So, the 12 becomes 6. So we're managing that fixed to floating. There's a higher percent that eventually becomes floating, but that's not much of a problem because it's like 4 or 5 years off. So we manage mostly the current year and next year. And then also, notwithstanding some people wanting rates to go really, really low, they're almost certainly going to bottom out on the Fed funds rate at 3. So you only have like a 1.25. So you might still hold like there are floating rate securities yielding 11. So even though they might go to 9.75%, it's still attractive. So we're looking at all that and managing the interest rate risk. And then, of course, we benefit from a spread basis because we borrow short term. So when Fed funds drops, our borrowing cost drops.
Got you.
So, taking all that into account, in general, if interest rates were to fall from here, how would that affect the returns from preferred stocks? I mean, you've talked about the yield to call risk. I imagine that would also increase the yield to call risk as well, right? If interest rates go down and companies are able to kind of call and then, reissue.
True. What we found, though, is, well, first of all, you had mentioned convertibles. There's busted convertibles, so they're not callable. So we have about 15% of the portfolio probably that is not callable. And then we also are buying some heavily discounted securities. So like it'd be a super high-class problem. Like there's a company that is, has the potential for a buyout. We think the credit's fine. We're adding very small at 12. So if it got called at 25, it would be the greatest thing ever happened. So there's securities that are just, there's securities that were just issued at really low coupons during the pandemic, like 4. They're trading at 17. So it's not like everything is going to go above par and all get called. And then what you'll find too, because preferreds are inefficient, rating agencies don't like them, they don't like a lot of the issuers, you'll still get opportunities to do 7s and 8s and floaters that might be even higher. So there's still opportunities. And so we're not concerned about an environment where everything's trading around par. Because also new issues, you buy them, they trade up. Things always are getting dislocated. The big index funds are dumping things for no reason. And they may not go to 20, but they'll go to 24. We buy them. So we're not nervous about that. And it's a bit of a high-class problem. Like roughly par, if all of our securities are marked to par, like PFFA would be at 25. And so, you're up $3 on 22, whatever that's 15, 20%. And then maybe it's more challenging for us to raise a dividend. It's kind of a high-class problem because you've gotten a good total return. And that's our job. That's why I said we're not likely to become good golfers because we just do this all day looking for opportunities. And it's just like a lot of investors won't even buy preferreds that don't yield 6, no matter what the interest rate is. So they're just a good asset class with good yields, and we don't think that those opportunities will go away.
Jay, maybe one more on PFFA. So in your second quarter commentary, you mentioned the term stag deflation. I think we've all heard of stagflation, but what do you mean by stag deflation?
So we've been historically, no guarantees going forward, but historically extraordinarily accurate about predicting both the economy and inflation. And the reason for that is we use just 2 indicators. The money supply, you get that data on our website. It's actually negative right now, and oil prices, which are also down substantially. So if you use those 2 indicators, you would think that inflation is going to continue to go down. And notwithstanding press reports to the contrary, it really has, over the last 5 months, annualized. There was a couple of bad reports at the beginning of the year. They're really bad for statistical anomalies. We're running at 2% already. We also publish CPI-R, so that's using mark-to-market shelter. The BLS is not just incompetent at estimating employment, they're even worse at the shelter component. They wait 6 months. So it's sort of like if you're running your business and you record like an interview like this, and then you don't release it for 6 months. Like, it's just incompetence. It's just horrible. So when you mark that to market, you also get inflation below 2. So we didn't think, number one, that you should even count tariffs because they're one time. It's like a sales tax. They take away buying power, and it should be ignored for the purpose of making monetary policy. But also, we thought that these other forces, like lower oil prices and a negative money supply, which is dangerous, would offset the tariffs. And that's really what has happened. And so we just said stag, we made up a word. We try to be not funny because finance isn't funny, but mildly amusing. So a lot of times, so we believe in the money supply. So like I was actually quoted or retweeted, I guess, by the president because I said, well, like this Fed chair, his attorney doesn't believe the money supply matters. And I said, well, that's like the Pope not believing in Jesus. So we always try to be slightly amusing, or at least offbeat. And so everybody's saying, oh, we're going to have stagflation. And we're like, that's ridiculous. You get stagflation. We've had it one and only one time in the United States. During the 70s, we had wage and price controls. So our oil production collapsed, had 2 wars in the Middle East. Oil went up 1,200%. That's what creates stagflation. None of it, not tariffs, not anything else. Inflation doesn't magically appear. It comes from almost exclusively excessive monetary growth, like during the pandemic. If you talk to people in Argentina, they would understand this. Increase the money supply by 100%, get 100% inflation. So it was just a dramatic way to say, you people are completely nuts. It's definitely not going to happen. And I mean, there's always arguments, particularly because it's kind of political, because some people hate tariffs for obvious reasons. But we really have had stag deflation. Don't think, I wouldn't wring your hands and say, oh my God, inflation could skyrocket any time. It only happens under those 2 conditions. The Fed is debasing the currency. Now they're actually making it stronger. It's shrinking, the money supply is shrinking. Or you have an explosion in really oil prices. It could be food, I guess, but it's really oil. The food increases during the 70s came from the fact that oil was skyrocketing. Food is about 40% energy. So forget everybody you listen to on TV. Inflation is determined by the money supply, oil prices, not tariffs. It doesn't randomly spike. It spikes when the Fed's too loose.
And then I guess we'll wrap up here with 2 more sort of questions on the economy. So I'm curious if you have any thoughts on the massive CapEx boom that we are currently seeing and the potential implications for real assets. Like when I look at big tech and the Mag 7 companies, these have historically been asset-light businesses that's almost exclusively invested in the digital world. But now those same companies are investing hundreds of billions into the physical world. So I'm curious if you have any thoughts on how this CapEx boom kind of impacts physical assets like real estates, energy, and some other old economy stocks?
Well, I guess my reaction would be thank God, because the normal cycle, so the Fed raises rates. Of course, the 10-year goes up as well, usually about 100 over whatever the Fed raises it to. And then housing and construction crater, which they have. And you can get that data on our website. I mean, that's just public data, but we summarize it for you in a slide on our website. So the old economy, so construction and housing are in recession. So over the last year, those investment categories have dropped. And by the way, investment drops create all recessions. But intellectual property, AKA, AI investment and equipment, which a lot of that's, semiconductors, and also could be data centers and could be power, is actually pretty strong. And so those 2 kind of cancel each other out, and we have modest growth. We think next year will be really good. But so we agree with you 100%, because, we were around for the internet boom, and it completely busted. Investment went down, but it was really, as you're pointing out, just some laptops and a bunch of tech engineers, so it didn't really have that big an impact on the economy. We had a very shallow recession, 0.6%, because it didn't impact data centers and chips and all these other categories. So we might get a cycle in the future. It's not housing driven, but it's solely driven by a cycle in tech, because it is kind of impacting the whole economy, not just software and laptops and tech engineers.
And just to follow up, in a recent interview, you briefly mentioned something about what you referred to as the Hatfield rule, as it relates to home building and the economy. Can you just briefly explain to us, like what is the Hatfield rule? Because I think it's an interesting concept, especially considering the current state of the housing market.
Right. So that also is meant to be slightly amusing because there's a thing called the Psalm rule, which is when employment rises quickly over 6 months. So we thought, it's a free country, so we'll come up with our own rule. But if you really look historically, as I mentioned, all recessions don't come from the consumer. So everybody's wrong about that. Everybody on television's wringing their hands about the consumer. It actually comes from drop in investment. And 12 out of 13 post-World War II recessions were caused by housing declines. And if you draw a line, we have a chart that shows this, you can see that once we go below 1.1 million, we do have a recession. And that was obviously the key driver in 2008, but it's been the key driver except every recession except that 2001 recession. Global rates are dropping, so housing hung in pretty well, and all the drop was in the the tech categories, but it was an extremely mild recession. So it is critical. So if you buy into our methodology of focusing on money supply, which is the Fed and oil, then the way, though, you need to also assess what's happening is look at the housing market. And that's why we had to call all year long that the Fed would cut 3 times, because we thought that the housing market was going to slow and then the labor market was slow. We looked like we were wrong for a while because the BLS takes a long time to figure out when the employment market's declining. So if you just have those 3 components, the Fed is the most important, and then housing, we're really just 2. You can predict the inflation in the economy nearly perfectly. You just have to make sure, of course, oil's not going to infinity, but that's not going to reoccur unless we have wage and price controls. Everybody kind of forgets oil was capped at $10 a barrel. World price was 40. Our production went to near 0, and that made the oil crisis way worse. So not likely to occur in the future on the oil side. So watch the Fed and housing. You don't need to listen to me pontificate. You could do it yourself and make your own forecasts. And we've been doing that since the pandemic. And like I said, historically it's been very accurate. And strongly, if anybody cares about macro, which you should if you're an investor, watch the money supply. Use the base. It comes out every Thursday, or look on our website. We keep track of it. I've been keeping track of it for 45 short years, ever since I studied monetarism in college, and it's kept me out of trouble. If you followed that, you would have been able to predict every recession, really.
Well, Jay, this has been so interesting. Thank you. One last question, if I could circle back to preferred stocks one last time. If you were designing a portfolio for an average investor, average risk tolerance, and maybe someone who wants to generate just a little more income from their portfolio, I don't think you'd recommend 60% or even 300% as you're invested. But what would that percentage be if for someone's portfolio to allocate to preferred equities? 10%?
Well, normally, like Marvell is a tech stock, and normally though we'd say, well, definitely don't buy more than 5%, right? Because we could be wrong. They've missed earnings a couple times. But with well, there's 2 reasons why you could do more, 10 or even 15 of preferreds, and that is it's diversified. So you're already not 5% in Marvell, you're 1% in 200 securities. And then you're senior to common, so if Marvell misses, it goes to 40 from 80. If there's a problem with a preferred stock, it probably goes from 25 to 23, or if the market's weak, it goes from 25 to 23. So it's a fundamentally lower risk asset class. Its beta is 0.5, Marvell's beta is 2.5. So, I don't feel nervous. Definitely don't do it, but, so I would say 5 to 15 would be perfectly reasonable. And if you called me up and said, you're at 20, I wouldn't tell you to freak. We have had investors. We have a pipeline fund, and that's an equity, so not senior to common. And we've had investors call us up and say, "Well, we're 90% in pipelines," and said, "That's
wow.
Definitely do not do that. That's a horrible idea."
Well, Jay, thanks again for giving the Motley Fool some of your time today. I know this is going to be really helpful, not only to our members that own PFFA or are already interested in preferred equity, but we have a large member base who who've probably never explored the asset class. And so I think they're going to find this super, super interesting. Thank you so much.
Great. Thanks, Matt and Anthony. Great questions.